Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can better your portfolio. Every single week I receive literally dozens and dozens of phone calls and emails from radio listeners just like you concerned about their money and really questioning what they should be doing with their money. And this is really, and I know I've talked about this often in my updates, usually on Wednesday and Thursday, but this is really where the rubber hits the road, as we say. If you do not have an investment strategy, folks, you're going to cost yourself not only in return, but also increased risk. Most investors who are doing it themselves are not really following any investment strategy at all. They're shooting from the hip. If you're working with a so-called advisor, not a money manager, not a registered investment advisor, but these so-called advisors who are working with brokerage houses or insurance agencies are not money managers. They are strictly salesmen of investment products using the title. They don't have a strategy either, and they are not responsible to manage your money. This is where I am finding the biggest pitfalls of retirees. Not having an investment strategy, which includes risk management in down markets. How do you protect your capital? If you're worried about your security and you don't have an investment strategy, you should be worried because you don't have a strategy to mitigate risk in down markets. Bottom line, anyone who doesn't have an investment strategy, and if it's not in writing, you don't have one. So if somebody can't produce an in writing investment strategy for you that you're working with, guess what? You're shooting from the hip. One of the problems that I see today is investors are underweighted various asset categories around the world. One of those is precious metals. We hold a significant percentage in our client portfolios, and have for a while, in gold. Gold is a buffer against risk, in my opinion, of a weak economy and certainly a weak dollar policy. I've talked about this many times, not only again on my videos, but on my radio show. Gold has really outperformed the stock market this year, and it's a hedge against not only inflation, but a weak dollar policy and fundamentals around the world. Not that you should overload the boat in the precious metals market, but I believe having alternative investment sectors in a portfolio is more important than ever. That's where relative strength investing in our strategy comes into play. Not only do we use relative strength investing, meaning we want to be in the relatively strongest sectors at any one time, and when a sector falls out of favor, it's automatically sold and replaced with a stronger sector based upon our dynamic investment strategy. Most investors are buying and holding because their advice they're getting is no advice at all, and they're really being bamboozled into thinking the person they're working with is really anything more than a salesman of investment product. This is where really you have to understand as an investor, you need to make sure not only if you're doing it yourself, you're actually following a disciplined strategy over time. Now there's times that strategy may underperform a little bit, but over a long period of time, in my opinion, any sound strategy has a chance to do well, but you have to have a strategy and follow it. Shooting from the hip is going to cost you money. I received a phone call on our radio show on Sunday, and the call went basically like this. A gentleman called me and said, Brian, you're talking about selling long-term bonds, but I've owned this particular bond for 10 years and it's done really well. Why would I sell it? Because this investor, again, doesn't understand why bonds went up. What I explained to him is he is called a rear view mirror investor, not looking out the windshield. Most investors, this would include you, usually like to buy investments that have already done well on past performance. Past performance is no guarantee to the future. So if you're buying stocks or bonds or mutual funds strictly on past performance and not understanding why they made that performance, and if the reasons that made that performance in the past are still valid today to give you an opportunity for the future, then you're basically buying something that may actually drop in value. Long-term bonds are one of the riskiest asset classes out there today, in my opinion. What I explained to this gentleman is, I asked him, why did your bonds go up in value in the last 10 years? He really didn't know. He just knew they went up. What I explained to him is that interest rates came down, and when interest rates come down and they're almost at zero, that bond values go up. What that means now is if interest rates are basically at zero and they can't go down much more, how would you expect the same return out of your bonds as you saw the last decade? You can't. In reverse, if rates start moving up slowly in the next 3 to 5 years, he could lose all the gain that he's made and have a negative return. So the bottom line is, because he didn't have a strategy, because he truly didn't understand why bonds and why the return was made on his bonds over the past decade, this person is setting himself up for basically, in my opinion, a lot of risk and mediocre returns in that portfolio, unless he was to sell and have a disciplined strategy to sell that bond position. You as the investor have to realize Mr. so-called salesman or advisor does not manage your money. You are 100% on your own. Unless you're dealing with a money manager or a registered investment advisor, then you don't have a money manager at all. You truly just have a salesman. That's when it comes into play for you to have your own investment strategy, which requires disciplined buy strategy and a disciplined sell strategy. When do you take profits? When do you move out of that investment for better and greener pastures? By the way, any investor who doesn't have risk management within a portfolio is taking the ultimate risk, and maybe that's why you've seen big collapses in your portfolio over the last decade from recessionary periods. Could we have another recession in the future? We certainly could, and that's why risk management is important. I hope this video was of interest to you and helpful, and hopefully opening your eyes to why an investment strategy is more important than ever, and why, if you are a rear view investor looking in the rear view mirror or past performance, is a big mistake. Look out the windshield for the future opportunities and what's going to propel your portfolio further, not only for income but growth. Also, Resny Wealth Management is officially opening our 4th office in Florida, in Naples, Florida, starting this week. So if you're an investor and you'd like to talk to us about your portfolio, you're serious about your money, and you're realizing maybe that person you've used all these years is not managing your money at all, and you really don't have an investment strategy and you're concerned about your retirement, call our office. We'd love to help you rebuild your portfolio in a manner that's conducive for you. Again, we did open an office this week in Naples, Florida, so that gives us 4 offices now in Florida: Fort Myers, Naples, Florida, Boca Raton, and Coral Gables, in addition to our Naperville, Illinois office. Call us. We'd love to help you at any time. Our office number 800-618-8577. And until Sunday's show, make sure you have yourself an extremely profitable day.